Hey there, future millionaires. Ever wished for a roadmap to navigate the complex world of investing? Well, look no further than Benjamin Graham's The Intelligent Investor. This book, my friends, is no ordinary read. It's your personal guide to building wealth, avoiding costly mistakes, and sleeping soundly at night. Graham, the OG of value investing, lays down the ground rules for smart investing. He teaches us to be patient, disciplined, and rational in a world driven by emotion and hype. Forget the get-rich-quick schemes and day trading fantasies. Graham's approach is all about long-term growth and building a portfolio that can weather any storm. The Intelligent Investor is not about hot stock tips or timing the market. It's about understanding the fundamentals of investing, managing risk, and making informed decisions. It's about being a business owner, not a gambler. This book is your key to unlocking a lifetime of financial freedom. So buckle up, grab your thinking caps, and let's dive into the world of intelligent investing. Listen up, folks. Before we even talk stocks and bonds, we need to get one thing straight: the difference between investing and speculation. Think of it like this. Investing is like playing a strategic game of chess, while speculation is like rolling the dice at a casino. Investing is about building wealth gradually over time by buying a piece of a business. You're looking for undervalued companies with strong fundamentals and holding on to them for the long haul. It's about partnering with great businesses and participating in their growth. Speculation, on the other hand, is all about trying to predict short-term market movements. It's driven by emotion, rumors, and hot tips. Speculators are more interested in quick profits than in the underlying value of a company. Now, there's nothing wrong with a little excitement, but when it comes to your hard-earned money, it's crucial to know the difference. Investing is a marathon, not a sprint. It's about making calculated decisions based on research and analysis, not relying on luck or gut feeling. So remember, be an investor, not a speculator. Play the long game, and you'll be amazed at what you can achieve. Let me introduce you to Mr. Market, your emotionally unstable business partner. Every day, Mr. Market shows up at your doorstep, offering to buy or sell stocks at a certain price. The catch? His mood swings wildly. One day he's euphoric, driving prices sky high. The next he's drowning in pessimism, sending stocks into a free fall. The key to dealing with Mr. Market is to understand that his emotions are not your own. Don't let his irrational behavior dictate your investment decisions. Remember, he's there to serve you, not the other way around. When Mr. Market gets overly optimistic, use it as an opportunity to sell if the price is right. When he's drowning in fear, look for bargains and scoop up undervalued stocks. Remember, every stock sale is also a purchase, so someone is always willing to take the other side of the trade. By separating your emotions from Mr. Market's manic-depressive tendencies, you can make rational decisions and take advantage of his irrationality. Remember, the stock market is not an accurate reflection of a company's intrinsic value in the short term. It's in these moments of market inefficiency that true opportunities emerge. Imagine you're buying a car. Would you pay the sticker price without haggling or doing your research? Of course not. You'd want to negotiate a lower price just in case there are hidden issues or the car isn't as valuable as advertised. The same principle applies to investing. That's where the margin of safety comes in. It's the difference between the price you pay for a stock and its intrinsic value, the true worth of the business. By buying stocks at a discount to their intrinsic value, you create a buffer zone to protect your investment. This margin of safety acts as a cushion against unforeseen circumstances, market fluctuations, or errors in your analysis. Think of it like this: you're buying a dollar for 50 cents. The wider the margin of safety, the less risky your investment becomes. This approach allows you to weather market storms and come out ahead in the long run. So remember, when it comes to investing, always leave home with your margin of safety. It's your best defense against the unpredictable nature of the market. Section 5. Defensive versus enterprising, finding your investing style. Not all investors are created equal. Some prefer a laid-back approach, while others enjoy rolling up their sleeves and getting their hands dirty. That's where the concepts of defensive and enterprising investors come in. Defensive investors, as the name suggests, are all about minimizing risk and preserving capital. They prefer to invest in established blue-chip companies with a long history of profitability. They're not looking for the next big thing. They want steady, reliable growth over time. Enterprising investors, on the other hand, are more hands-on and willing to take on additional risk for potentially higher returns. They spend more time researching and analyzing companies, looking for undervalued opportunities that the market may have overlooked. So, which type of investor are you? There's no right or wrong answer. It all depends on your risk tolerance, investment goals, and how much time and effort you're willing to put in. The important thing is to choose a style that aligns with your personality and financial objectives. Remember, whether you're a defensive or enterprising investor, the principles of value investing still apply. Buy low, sell high, and always have a margin of safety. Section 6. Stocks and bonds, building a balanced portfolio for steady growth. Building a well-diversified portfolio is like constructing a sturdy building. You need a solid foundation and a mix of materials to withstand the test of time. In the world of investing, stocks and bonds are your building blocks. Stocks represent ownership in a company. They offer the potential for higher returns, but also come with higher volatility. Bonds, on the other hand, are like loans you make to a company or government. They typically offer lower returns, but provide stability and income. The key to a balanced portfolio is finding the right mix of stocks and bonds for your risk tolerance and investment goals. Younger investors with a longer time horizon might allocate a larger portion of their portfolio to stocks, while older investors closer to retirement might prefer a more conservative approach with a higher bond allocation. By diversifying your portfolio across different asset classes, you reduce the impact of any single investment on your overall returns. This balanced approach helps you weather market fluctuations and achieve your financial goals over the long term. Section 7. Financial analysis. Unlocking a company's true worth. Ever heard the saying, "Don't judge a book by its cover"? The same goes for investing. Before you buy a stock, you need to look beyond the stock price and understand the company's financial health. Financial analysis is like detective work. You're digging through financial statements, looking for clues about a company's profitability, debt levels, and overall financial strength. It's about understanding how a company makes money and if it can sustain its earnings in the future. Think of it like this. You're buying a business, not just a stock ticker. By analyzing a company's financials, you can determine its intrinsic value, the true worth of the business. This allows you to make informed investment decisions and avoid companies that may be overvalued or on shaky ground. Remember, investing without financial analysis is like driving with your eyes closed. You might get lucky for a while, but eventually you're bound to crash and burn. Section 8. Common pitfalls. Avoiding the traps of emotional investing. Investing can be an emotional roller coaster. One minute you're riding high on market gains, the next you're plummeting into the depths of despair as your portfolio takes a hit. The key to successful investing is to avoid letting your emotions cloud your judgment. One of the biggest mistakes investors make is buying high and selling low. When the market is soaring, it's easy to get caught up in the excitement and buy stocks at inflated prices. Conversely, when the market crashes, fear takes over and investors sell their holdings at a loss, locking in their losses. Another common pitfall is following the herd. Just because everyone else is buying a particular stock doesn't mean it's a good investment. Remember, the market is driven by emotions, and what goes up can come down just as quickly. The key to avoiding these pitfalls is to have a sound investment plan and stick to it. Don't let emotions dictate your investment decisions. Do your research, buy undervalued companies, and have a long-term perspective. Remember, investing is a marathon, not a sprint. Stay disciplined, stay focused, and you'll come out ahead in the long run. Section 9. The Intelligent Investor, Timeless Wisdom for Modern Markets. So there you have it, folks. The essential ingredients to becoming an intelligent investor. We've covered a lot of ground, from the dangers of speculation to the importance of financial analysis. Now it's time to put this knowledge into action and start building your own path to financial freedom. Remember, The Intelligent Investor isn't just a book, it's a philosophy, a way of thinking about investing that has stood the test of time. It's about tuning out the noise, ignoring the hype, and focusing on the fundamentals of sound investing. In today's fast-paced world of algorithmic trading and high-frequency trading, it's easy to get caught up in the frenzy. But the principles outlined by Benjamin Graham remain as relevant as ever. By adopting a long-term perspective, focusing on value and managing risk, you too can become an intelligent investor and achieve your financial goals. So what are you waiting for? Go out there, make smart investment decisions, and watch your wealth grow.